The Federal Reserve have cut interest rates again, this time by 25 basis points, marking the second rate cut in 7 weeks. For more, let's welcome in now Esther George, former president and CEO of the Federal Reserve Bank of Kansas City. Esther, it's good to see you. So the Fed does cut by a quarter point as expected. Esther, we did have some guests on the panel, Esther, saying that they thought it tilted perhaps a bit more hawkish in the statement. But let's get your reaction, your response, Esther.
Yeah, so the 25 basis points certainly was expected. Very little change in the statement from my perspective. And I think if any lean hawkish, it simply is in the context of an FOMC that sees uncertainty ahead, and they're going to keep their options open.
Do you think that there is more uncertainty today than there was on Monday? In other words, do you think, is the uncertainty just what we're seeing in the economy? Is the uncertainty more of the fiscal variety? How are you sort of judging those risks?
So I think it is really a combination of things that makes now an uncertain time. Obviously, this is a committee that is trying to judge where an equilibrium is in our economy in terms of how many rate cuts, how fast they need to go. They see and have seen for some time fiscal issues ahead. And certainly when you have a new administration coming in, a new Congress, they'll be thinking and watching carefully how any new policies may come to bear on the economy.
And Esther, what do you think the rate path looks like from here, December, January, and is it more cuts? Is it a pause? If it was a pause, what would that depend on?
Well, the pause could come if there was any unexpected data that would surprise. But my guess is they will be pretty steady in thinking about what was already in play. It's too soon, I think, for them to know what changes lie ahead for 2025. So I think you could see another rate cut in December. And then I think the path is really up for grabs, depending on how they hear the potential for policy. We're watching the 10-year, which continues to show some upward pressure. And I think this is a committee that understands they're not yet achieving their goals. They still have inflation over target. They're happy with the labor market where it is, but they have more work to do.
I'm glad you brought up the 10-year because we have been watching it and talking about it a lot, the fact that it is moving upward while we are seeing rates go down, and a lot of folks talking about that that's reflective of the optimism about economic growth, some talk also about fiscal policy and that effect. As someone who was inside that room, how much is the committee watching yields and watching the bond market?
Well, you watch them very carefully, and of course they can move around, but what you're looking for are indications of how tight or how easy financial conditions are and what expectations lie ahead for this committee as they set their forecast. We'll see in December updated individual forecasts that will come out in the dot plot and have a better sense of how this committee is thinking about the path ahead. So I think that's going to be important here because they are watching financial conditions very carefully.
Can I ask you, Esther, what is the right level of rates? What is the final stop for the Fed here? Is it around 4? Is it 3, Esther, lower?
Well, I guess we all are looking for the answer to that, as are members of that committee. And as Chairman Powell has said on a number of occasions, we'll know it when we see it. We have to sort of see how the economy settles out. It's why I worry a little bit about focusing too much on soft landing, because that, in fact, is not the objective for the Fed. The Fed has very clear mandate around its inflation target and employment. So it's really wrestling with those variables to judge when they think this economy has reached an equilibrium. So is it as high as today? Not likely. Will it be higher than we saw over the past decade? I suspect it will be.
Well, I do want to ask you one political question about something that has been floated either by President-elect Trump or people within his campaign, which is he said he would not fire Jay Powell as head of the Federal Reserve. But there has been this idea that perhaps before the chair's term is up in 2026, that a new Fed chair might be announced or nominated well in advance. What do you think that would do? I mean, we have seen things like that where we've seen the independence of the Fed sort of ebb and flow throughout the years. What effect do you think that would have on policymakers' ability to set rates?
So I think there's always some level of speculation about who the candidates could be for a position like that when you can see that a term is coming up. On the other hand, I think Congress is going to be very focused on understanding it could be unsettling to markets. It could be unnecessary in many respects to have that kind of an issue come forward. So the Fed chair is secure in their seat until their term is up. That's part of the independence of this institution. And I think that's where certainly the current members will be focused. And I think Congress is going to be sensitive to this issue as well.
You know, it's interesting, Esther, the Fed chair is securing that seat. I just wonder, let's say the Fed decides, early next year, you know what, we're looking at the data and a pause makes sense. You could see a situation, Esther, in which that decision wouldn't go over that well with our president-elect. I'm just wondering how you think that dynamic could play out.
Well, we know that when politicians don't like what the Fed is doing, they often are very vocal about that. And we've seen that time and time again in the past. It's really the job of the Fed to stay focused on its mandate, which is given to it by the Congress. And so it will require the Fed to stand up to pressures that it may receive, whether they're simply rhetoric or they're more, I think, direct threats. But I think the Fed is well prepared and able to focus on where its mandate lands, and that is securing its mandate on behalf of the American public. And that will be an important aspect of how they set monetary policy for the country.
Esther, thank you so much for your time. Really appreciate your perspective. Esther George is former president and CEO of the Federal Reserve Bank of Kansas City. Thank you.
Thank you.